What's up, everybody? It is John Bloor coming at you live. I'm filling in for Stephen Choi today. This is a special edition of Trading with Livevol. So, if you remember last time I was here, I spoke a little bit about a SPX credit spread strategy, and I'm going to talk in a little bit more detail about that today. So, if you traded today, you know that there wasn't a whole lot of real movement in the markets, at least from start to finish. Little intraday movements, but in the end, nothing really that crazy happened. Sorry, some background noise. Living in the city. Sorry about that. There wasn't a whole lot of movement from start to finish. So given that, I figured this was probably the best thing I could talk about was an interesting strategy. Plus, to be quite honest, from talking to people, it seems like people are more interested in actual strategies than just me talking about the daily market. So to get to the strategy, it's an SPX weekly strategy. I've only traded it on the SPX weeklies. Now, you probably could trade it on just about any weekly traded indexes. You could probably even trade it on specific equities if you wanted to. Now, again, if you know me, and if you, sorry about that. So again, if you know me, and if you know kind of what I talk about, what I like to do, then you know that I don't particularly like trading equities that much, unless we're talking an earnings play or a specific instance. But just on a regular basis, I tend to trade indexes more, because I don't want to have to worry about earnings plays. I don't have to worry about news coming out. I don't have to worry about the CEO being fired or anything like that. I can sort of take a different approach. I don't have to worry about those types of events or those types of things. So I can trade more expiration cycles. I can trade more regularly. The indexes also are larger, so typically they're larger. They're more liquid typically. I kind of know everything I'm getting with them. I don't have as many fears or worries as I do when I'm trading specific stocks or equities. So that's why I like to trade indexes. So you know, it's your call. Also with the indexes, I'm not sure how many of you guys really think about this, but tax implications. The tax implications on trading options on indexes is different than the tax implications on trading options on stocks. So if I traded some options on IBM or Apple and I made a gain, those gains are taxed at the short-term rate. So if I made an options trade and I sold a credit spread 30 days out and I made $2, that $2 is taxed at the short-term rate, which is high. And if I did that on the Russell, for example, I would be given favorable tax treatment. I think it's 1256 it's like 1256 contracts and straddles and strangles or something like that is what you have to, a form you have to fill out when you do your taxes at the end of the year. But you're taxed a percentage at the long-term rate and a percentage at the short-term rate. So you pay less taxes than you do if you were to just trade on equities. Now, if I see edge in a trade, I don't care what, I'm going to take the edge regardless of tax implications. But on a regular basis, it does make some sense as well to trade the indexes because you're going to be paying less taxes. So again, all reasons why I like to trade indexes. Now, to the specific strategy itself, again, so I traded on indexes. You could trade it on just about any cash settled index as long as they have weekly options, I'd imagine. I like to do it on SPX. The SPX weeklies are electronically traded, which I like as well. So we have that going for us. And the SPX tends to be a little bit of a slow mover, so it doesn't tend to be as volatile as some of the other indexes. So that's why I like to trade it. So that's the SPX is the only one I've ever done this strategy on. So if you're going to do it on another underlying, be cautious. Let me share my screen. All right, let me go to my my browser and go to here. Alright, so I wrote a blog post on this to make this a little bit more clear. So you should now see it. If you go to Livevol Community and go to blog, you'll see SPX Weekly Credit Spread Strategy. So I traded this last year for the majority of the year. I didn't trade it every single week, every single expiration cycle for the weeklies, but I traded it fairly often. And I think I averaged twice a week on average, so it was somewhere in the neighborhood of like 24 trades last year I did with this specific strategy. And I had some winners, had some losers, but in the end I averaged 4.7% on my capital per trade. So not bad, not a bad strategy. It was definitely a decent winner. And it was super simple to put on and take off. So in terms of the framework, I got this framework, this trading framework, from a presentation I watched with the great options trader, author, and expert Jim Bittman. So credit to him. The framework is here. Simply look at the guidelines. We use the Wednesday's closing VIX to calculate a fourth of standard deviation and a half a standard deviation move for the SPX. Now, if you're doing a different underlying, then you want to modify that and do it for whatever underlying you're going to try to trade this on. Then you're going to use Thursday's opening for the SPX to add and subtract the number that you got from step 1 to determine the entry and exit prices. You want to write down what the SPX would be at after a fourth of standard deviation move and a half a standard deviation move, both up and down. So that's going to give you 4 different numbers or price points for the SPX that you're going to need. Write those down. You're going to have to reference them later in management of the trade. So write them down. I like to do this in a spreadsheet myself. I would highly recommend that. That way you can track your trades, the history of your trades, and you can tweak your trades moving forward. Spreadsheets really make things a lot better. I love spreadsheets. So then start looking to enter the trade on Thursday morning after you get these numbers, and you're going to look at the options that are expiring the following week. So this could be anywhere from like a 9, 8, 7, 6, 5-day strategy. So it's going to be a 9-day strategy and it's a short-term strategy. Again, weekly options we're trading here, just very short-term. So you can trade this, in around 4 times a month, 4 expiration cycles per month, so you get 4 chances or 4 opportunities at this every month. If the market rises or falls a fourth of standard deviation from the price that you wrote down in step 2, that opening of the SPX, then that is an enter trigger. That's an entry trigger. So if from Thursday's open the market moved 1/4 standard deviation up or down, that's an entry trigger. So if the market went up a fourth of standard deviation, then you're going to sell a put credit spread, and you're going to sell it with the short strike being a half a standard deviation down from Thursday's open price, which is what you calculated in step 2. If the market goes down a fourth of standard deviation, then you're going to sell a call credit spread with the short strike being a half a standard deviation move above Thursday's open price, which is again that number you would have calculated in step 2. Keep in mind this may happen on Thursday or Friday of the same week, or could even happen on Monday, Tuesday, or Wednesday of the following week. It might not even happen at all, to be quite honest. You don't know. But when it does happen, that is the trigger point for entering the trade. Most weeks it's probably going to happen, at least in one direction or another, before the weekly options expire. The closer you are to expiration, the smaller the credit is going to be, but that's offset by the fact that your probability of profit is going to be extremely high. So, if it happens right away on Thursday, you're going to have a pretty large credit, and but your probability of profit is going to be not low, but not nearly as high as it would be if it happened with only a few days to expiration. And again, if you're maybe, let's say, 2 days to expiration, the credit that you receive, your risk-reward ratio is going to be pretty poor, but your probability of profit is going to be very high. So just keep that in mind. And again, that's options, guys. That's the trade-off, the great trade-off. that you're going to have to deal with. There's no perfect trade. So if you want a high probability of success, then you're going to have a poor risk-reward ratio. So sorry. And then for the exit, I keep it simple. I put the thing on and then I take it off. So if the market retraces and goes against me and it hits that 4th standard deviation mark in the direction of my short strike, then I'll immediately exit the trade regardless of profit or loss. So if I'm up money, great, but if I'm down money, hey, that's the breaks. It's a losing trade then. If the market does not retrace against me and does not hit the 4th standard deviation price, which is again what I calculated in step 2, then I'll just let the options expire worthless for profit, and you made your full credit. Congratulations, you got a winning trade. Risk management of the position is built into the framework and the guidelines for the exit. The risk management is just simply taking the trade off if it goes against you to a certain point, or letting it run if it doesn't. So that's really the risk management of the trade. Additional risk management would be that I like to employ, at least with this trade, is that I am very picky on my entry, and I won't do it if I feel that there's too many news events that are going on. Let's say like this week with the FOMC meeting, I said that I was kind of hesitant around doing it because the Fed was meeting and there was going to be some meeting minutes and some other things. So I said, you know, it doesn't feel good for me. I don't want to do it this week. So I won't enter the trade if I feel like there's going to be a big news number that's going to really move the market. Now, keep in mind, there's always going to be some news events. There's always going to be some market indicators released or things that are going to potentially move the market. So you're going to have to get comfortable with that. But there are ones that are larger and more infrequent than others. So you just have to find out what makes you most comfortable when putting this trade on, and then just manage it that way. Now, you can manage the trade if you want and experiment with this. If you prefer to employ typical risk management techniques, such as when the trade goes against you, you buy some long options to hedge yourself and keep you in the trade, hoping that it comes back in the other direction and cut your deltas down. Or if you want to do something with spreads like that, or even morph this thing into a butterfly, if you know it comes at your short strike, then you're welcome to do all those things and try them. But you know, I really don't trade it that way, and I don't trade it that way just because I like to make it super easy on myself and I like to keep it simple. I'd rather sacrifice a little bit of the profit and make it a little bit more simple so I can't screw it up than to try and complicate things, overcomplicate things, and overtrade the position. That was something I struggled with when I first got started, was overtrading the position. So now I just try to keep it a little bit more simple and not do too much. I basically just try not to screw up the trade once I put the thing on. So the trade example, and this should make things a lot more clear than those guidelines. So this is for this week. So I just did this today before doing this. This is for this week. Wednesday's closing VIX was 1061. Wednesday's closing SPX was 1956.98. Now, you don't necessarily need to go to the decimal points on this if you don't want to, but I'm kind of a perfectionist and a stickler on this, so it's in my nature and I do that. Thursday's opening for the SPX was 1957.50. So now that you wrote those numbers down, you want to do some calculations, and you want to calculate a 1 standard deviation move based on these numbers, these inputs. 1 standard deviation moves 35 points. So from there we can easily get the half and the 4th standard deviation moves, a half being 1750 and a 4th being 875. Now we have our entry and our exit prices that we can easily calculate with these numbers. So here are the entry and the exit prices. We have a half standard deviation move up on the SPX, and we know that's going to be at 1975. That's going to be the strike price for the short option of the credit spread if you end up selling a call credit spread. Then we have a 4th standard deviation move up, and that's going to be at 1966.25. This is going to be the entry trigger for opening up a position, the bullish entry trigger. Now we have the fourth standard deviation move down, and that's going to be at 1948.75 on the SPX. This is going to be the entry price trigger for a bearish move, a down move. So if it goes down and it hits 1948.75 on the SPX, you know, open up a trade. And then we have the half standard deviation move down, which is going to be at 1940, and that is going to be the strike price for the short option of the credit spread that you would sell if you were opening a position on the puts. So again, remember, if it goes up a standard deviation, you're going to open up a position by selling the short strike, half a standard deviation move down at the 1940 level. So if the SPX hits 1966.25, you're going to sell the 1940 option, and then you can go either 10-point or 20-point wings, or whatever risk tolerance you're willing to take. I typically just do 10-point wings. If the SPX hits 1948.75, then you're going to go ahead and you're going to sell a call credit spread at the 1975 mark. If it doesn't exist, then you'll either have to pick the 1970 or the 1980. So that's going to be sort of a personal game time decision that you're going to have to make. And make that decision based on your risk level, your tolerance, how aggressive you want to be, technicals, whatever you want. So, bullish entry, again, to reiterate, if the SPX touches 1966.25, then sell a put credit spread with a short option at 1940. Close the trade if the SPX touches 1948.75. Bearish entry, if the SPX touches 1948.75, then sell a call credit spread with the short option at 1975. And close the trade if the SPX touches 1966.25. That's it. It's that simple. That's going to at least get you started. And if you want to tweak the trade, if you want to modify it, do some more risk management techniques in order to try to make your probability of profit and your probability of success greater, feel free to work around with that. I'd love to hear what you have to say, and feel free to post that in here if you tweak it and it works out for you. But that's the trade. Pretty simple. And again, I'm really picky on the entry more so than anything else. So I won't do it around big news items, news events typically, and if the technicals don't line up and I'm looking at technicals and it just doesn't feel right to me, if I feel like I'm trading in the wrong direction based on technicals, then I won't open the trade either. But that's the trade. Again, find it in the Livevol community blog and give it a shot. Give it a shot on paper before trading it live. I'd always recommend that. And other than that, happy trading, good luck, and we'll talk again soon.